Good morning. You're watching The Market right here on 89 with me, Aisha Faridi, Ajay Sharma, Avan Dabash in the studios. And the rally sustains. For a second consecutive day, we've seen the Nifty actually scale up and latch on and participate amidst the global rebound which is taking place, while the turmoil, of course, between Israel and Hamas still continues. Having said that, yesterday you did see participation coming in from blue chips like Reliance, HDFC Bank. They were the ones which were leading gains, while IT was the one which little bit underperformed. Autos as well held out quite smartly. You had the Nifty Realty Index as well, gained for a second consecutive day. So yes, the large cap, strength continue. The broader markets as well held in tow. But yeah, Ajay, the FIIs selling, that also continues now for a 16th day in the running.
Good morning, Avan. Good morning, Aisha. Aisha, there are two ways to look at it. If you look at it in composite for the last 15 days, yes, you would be staring at a big FII sell figure. But I think we need to divide these 15 days into two parts. The first part of selling in these 15 days are actually because of global cues, which in the last week or so have completely turned over. In the last 4 days, if you see, Monday being the peak of FII selling in the near term, at least this week at least, we are actually going down. Only 421 crores of cash selling. And if you would look at the F&O side of the data also, you would actually see FIIs load up positions on index futures as well as stock futures. So I would actually not bother a whole lot on FII selling, at least this week. I'll look at it on a weekly basis, because overnight today also you are looking at bond yields coming down, dollar index is below 106. So this is actually good for emerging market flows. So my expectation is that in the next few days that the FIIs may continue to sell, but much lower side. That 1,500, 2,000 crore a day kind of a wholesale selling may not happen.
Yes, indeed. So like you said, the number of that FII selling figure has seemed to reduce. And yes, in the last few days compared to what we saw at the start of the week, etc., that FII sell figure seems to have dwindled quite significantly at that. Time to take stock of what's happening across the globe then, and despite all of the global turmoil that we're dealing with and geopolitical concerns and tensions that are raging on, we did have the Dow Jones as well as the Nasdaq and the S&P 500 that closed the main trading session with a fourth consecutive day of gains. It was mildly in the green, but nonetheless, you had the Nasdaq, which actually gained about 0.7%, and that closed above its 50-day moving average for the first time since the month of September. So a lot of data as well that has been looked at, the fact that there have been upbeat Fed minutes, the inflation data as well. The consumer price report for September is going to be released later today, where the expectation is there could be an increase of about 0.3% on a month-on-month basis. Apart from that, you've got the Asian screen as well, which is pretty much piggybacking on that momentum. So you've got the whole of Asia, the Australian markets as well, that have kick-started on a positive note. That's the Gift Nifty implied rates, and absolutely flat around the 19,849 mark. So even when we're taking note of what's happening with other asset classes like crude oil prices, after the Saudi pledge, it fell over 2%. But by and large, Ajay, you've got even the global screen, which is holding out in light of the kind of volatility that we're seeing in the situation play out.
That's correct, Avan. I mean, we couldn't have asked for a much more supportive global setup. If you look at yesterday's price action on crude, after Saudi ensuring that they would see stability in the oil market. And this meeting actually happened in Moscow between Saudi, some other players, and of course Russia. This is a very positive news. They are trying to do their bit that this doesn't become a Middle East issue. It is just an issue between two parties. So this is very good for us. We are huge users of crude. Meanwhile, we've been buying discounted crude from Russia. And probably that is the reason why you saw bond yields here back home also come down. Bond yields have a very direct relation with crude oil prices. So this is good news for us. And globally, of course, the US bond yields and dollar index have been coming down. So, but at the same time, yes, FI flows are on the lower side. Yes, global cues, including crude, is supportive. But I'm very keen to, I was looking at some charts, and we will take this discussion forward with Nuresh and Kunal also. At 19,850, we might be hitting some kind of a technical hurdle, because all these positives on the global side, may actually coming to a kind of factoring in situation also. So we'll watch out for that one.
We will, as we will react to TCS as well, the first of the IT majors to come out with its numbers post-market hours yesterday. And, just looking at the scorecard, it may not really indicate the nitty-gritties or the finer nuances of what transpired in the earnings gone by. So, yes, there's been a miss on the top line, while the PAT and the margins have been a beat. But Q3, while it was supposed to be seasonally a weak quarter as well, the street has sort of written off FY24. FY25, as indicated by the management, is looking good on strong order book as well as margins. It's the same demand outlook as the first quarter. There's no clarity on recovery yet. But I think what's going to disappoint the street after two muted sessions from TCS in trade, last two trading sessions, is that the quantum of the buyback, that was definitely lower than what the street was anticipating. So the buyback announced is for the quantum of 17,000 crore rupees at 4150 rupees per share. So that's lower than estimates, and that's also lower, Ajay, than what they announced last year.
Well, that's correct. And guess what? This is topping up with TCS actually being one of the best performers from the recent lows as well. So if you look up, if you could pull up the chart in the last 1 month, 3 month basis, you would see that TCS, not only on the valuation front, became almost premium to many other of its own size, the larger ones. Look at that. 1 month, the stock has actually gone up by about 1%. 3 month stock is at highest level. So it had already moved out quite a lot from the 2 quarter back kind of a lower levels. And now you're looking at a buyback amount 10% lower than what the street was estimating, and results, of course, on the softer side. But you remember, Aisha, we were, on ET Now, along with Anisha and among ourselves, discussing that this sudden buyback could be also, kind of an attempt to mask slightly softish quarters, and that's exactly how it came about.
Yeah, and I'm just waiting to see what the stock reaction is going to be today. And, more importantly, you've got HCL Tech up next. What can we expect from them when TCS is the one which has sort of soured the flavor for IT earnings on the street? In fact, let's hear out what the management as well had to say post the numbers.
See, to some extent it's broad-based, but we've been explaining it last quarter also. Okay, the trend is same. Essentially, clients want to invest in newer technologies. So technology adoption is very high, and given the macroeconomic uncertainty, there is also a lot of request towards cost optimization projects. So we are able to sign new projects, and the project that we sign, we continue to execute them, and they yield the revenue as planned. But in any given quarter, there will always be some amount of degrowth. Essentially, some projects will be complete, they come to a natural end, and some projects will get downsized. So if the degrowth is much stronger, or usually in a regular good growth quarter, there will be less of degrowth and more of new addition coming in. So net, you see a lot of growth. But what's happening now is that we are not fully compensating for the degrowth, which is more normal process, but we are not fully compensating because clients are also optimizing or pausing some of the ongoing projects, and so there's some deferral happening. So that's the reason why you see, while the TCV is still strong, the revenue growth is not reflecting in.
That's not it. We'll hear out live from the TCS top brass as well at 8:25. Hear it out from Samir Seksaria, the CFO, and Milind Lakkar, the CHRO. And of course, at 8:45, we're going to have K. Kirtivasan on the show, the CEO, and TCS and Ganpati Subramaniam as well, the COO. They're going to be exclusively in conversation with us. But yeah, like I was saying, Ajay, if that's the reporting from TCS, what can we expect from Infi and the likes?
Well, it's a very confusing situation if you look at all the data points, Aisha, because Gartner was the first overseas agency which came out and said that, look, the situation on new deals and the visibility may not be as bad as the street actually penciling in. And then there was a big rally. And IT, the nature of this sector became buy on dips, because indeed we saw big deal flows coming in on some of the major ones, HCL Tech, TCS also. Then we saw some of the influential brokerages come on saying that valuations are very supportive, cash on books, etc. is very attractive, and one should be a buyer. So people have been getting in, getting out last 6 months in IT. So this is the quarterly number where the result and commentary will actually decide whether people will be interested in buying this sector on dips. Just look at yesterday, right at the just beginning of the result, there was an unwinding of that position. The slate has been cleaned. Now commentary and result will decide how the street takes this sector, whether indeed it's very attractive for buy on dips, or they'll give it a time and the stock, the entire universe may go sideways.
In fact, that's the question I want to pose to our chartists as well. We've got Kunal and Naresh joining in as always. Kunal, Naresh, hi, morning. Kunal, before the index, let's talk about IT since we were on the subject. What do you think IT is going to do next? Because, going into the earnings, some of these stocks have taken a bit of a backseat. TCS, for instance, has consolidated for 2 days. But the numbers, the buyback is not at par with what the street was expecting for TCS. Do you think that's going to call the shot for the rest of the IT pack as well? And are we going to now see, the move up in IT rewind itself?
Good morning, Aisha. So I don't believe that we may see a major rewind on the IT stocks, and especially the move which you've seen for many of the larger cap names. Many of the large cap stocks have actually done pretty well for themselves, and I'm talking of it from the September 2022 lows, when I think, for example, TCS was at 3,000, 3,100 levels, and Infosys was around, 1,100, 1,200 mark. So I think from that point of time, these stocks have done reasonably well for themselves, rising up very slowly and gradually towards a 30%, 20% kind of a return for themselves. Now, yes, on the short-term charts, for example, yesterday, the candlestick pattern, the price action for the Nifty IT index selling off from the day's high and closing very near to the day's low yesterday indicates that there may be some bit of short-term weakness. But even the last, I think on the IT index specifically on the last 2 or 3 months, we've seen that the IT index has taken a bounce at the 50-day moving average. So even in that scenario, I would believe that retracement towards that average should be actually taken as a good buying opportunity.
Okay, a buy on dips if there is a retracement at all. That's the call coming in IT. Naresh, hi, morning. What about the index? 2 days of a very swift-paced recovery. Do you think it's going to hit a hurdle anytime soon?
So, say overall the momentum is positive, the trend is up, but we'll keep seeing reactions as per results over the next 2 to 4 weeks. So as of now, the bias is positive. We may take a little bit of a hit today due to, say, a gap down in TCS. But overall, a short-term base has been done at 19,300. And going forward, 19,500 should act as a support. And on the upside, we can again go back and test 20,200, 20,300. So that's the view right now. Closer to 19,600, 650 is where you want to buy on a dip. Overall, continue to hold, have a positive stance on the Nifty. And we are starting to see some bit of recovery in the heavyweights like Reliance Industries, HDFC Bank trying to make a recovery. Kotak Mahindra Bank made a recovery in the last 2 sessions. So if any of the heavyweights start taking a trending move, we could get a much easier start on the upside.
Kunal, I also want to follow up on Bank Nifty, because if you compare Nifty's trading action, after gap up we maintained bulk of the gains, but Bank Nifty was underperforming. In fact, in the last hour trade, it came slightly on the lower side as well. What levels are you watching out for on Bank Nifty?
So, Ajay, I believe 45,000 broadly is a major resistance point for Bank Nifty, and I look at it this way, that the recent high for Bank Nifty was around 46,200, 46,400 for the banking index. This was in the month of September. We made a low which was around 43,800 mark, which means there's been a distribution of almost 2,400 to 600 points for the Bank Nifty, and that's where we look out for midpoint of this range. That's 45,000 approximately for the Bank Nifty. Now this becomes a major hurdle, retracement, psychological mark, as well as a major resistance for the Bank Nifty. And I think that's where I would believe that the impetus for the Bank Nifty would probably intensify if we expect and if we see the 45,000 mark being taken out, because I think that could be a decisive indicator that the Bank Nifty is not just making a comeback for itself, but then it's getting back into the line of possible outperformance or ending its zone of underperformance.
All right, let's find out those individual stock strategies then in light of that, Kunal.
So I'll go with larger cap names. First one is a buy on Ultratech Cement. That stock is looking quite attractive. In fact, on the hourly charts, it's actually forming a bullish RSI divergence setup over the last 4 to 5 days. So would expect targets of 85.50 on Ultratech, stop loss to be kept at 80 to 30. And Reliance Industries, something which has been taking support at 2,300 mark. Yesterday showed good signs of recovery. Expecting this to be a steady short-term recovery for Reliance Industries. Buy with a target of 24.20, stop loss 2,300.
Okay, it's Ultratech and Reliance Industries heavyweights getting a thumbs up from Kunal. What about you, Naresh?
So focusing on the mid caps, which have been showing strength. First is a buy on NMDC. The stock gave a breakout about 147, 150 levels. Made a move towards 153, pulled back a little, so giving a good opportunity. A risk reward trade here has been showing a lot of strength, and the whole mining space looks interesting. NMDC has a lot to catch up. A stop loss at 145, target price of 170. Second is a buy on Sun TV, which has tried to give a multi-year breakout. 600 to 630 has been a resistance for a long time. A little bit of a pause here before it breaks out. Going forward, once it breaks out, could see a move towards 700 plus levels. Target price of 700 plus, stop loss at 600.
Tell you what, we'll slip into a very short break with all of those top technical recommendations and come right back as we continue our market talk and tell you which stocks will be in news today.
All right, let's take the discussion forward on markets. Sanjeev Hasin also joining us. Sanjeev, good morning. Your call on that panic day of buying the market and we'll rebound fast came out pretty accurate, I must say, particularly Reliance Industries, which was leading from the front yesterday. So what's the take now? The near-term profit taking should be done, or one should be holding those positions which one bought in that panic day on Monday?
Yeah, good morning, Ajay. Ajay, two things have happened. One, the war has been an opportunity for yields to fall. And I mean, it's a very unfortunate event, but yields have fallen sharply. Dollar has started to seeing a correction, and oil has come back to, after that Saudi pledge. So all three make up for a very good potpourri for India and emerging markets. We are at the cusp of earnings seasons. I think TCS numbers were fairly in line, and I think the party is just starting. So you could see a little bit of plateauing on the index, but I don't think we will rest before we hit new highs. And like I said, second week or second half of October, we'll see new highs. So stay invested. Try and pick up your stocks. Banks are starting to outperform on yields, and I think now you'll see a lot of energy stocks, particularly the OMCs, and Reliance lead from the front. Reliance has just started a move. Ajay, it will go to 2,600 plus by Diwali.
Okay. By Diwali, clearly, I mean, below the 2,300 mark, we have not seen, I mean, this was a very important technical level as well. The moment it fell below that level, completely oversold. In fact, Somit had done some analysis. It was one of the most oversold stocks in the entire index component. The stock has actually come back. What are the other stocks which are there on your radar, Sanjeev?
So I'll give you three names, maybe four quickly. Firstly, the oil marketing companies. Look, the fall in crude and the rupee strength, all both bode well for margins. IOC, BPCL will report stellar numbers, all three of them. So today I would say go with IOC and BPCL. By the way, yesterday or day before, I gave you Gale and Ashok Leland in intraday trades. They rose more than 3%. And they've been very smart traders. And yesterday was Reliance and SRF. Today, I am very, very bullish on the OMCs. IOC, BPCL fit the bill perfectly. Earnings will surprise on the upside, plus the fall in crude and strength in the rupee will add to the margin. Third would be SBI cards. Credit expansion on the card business is seeing extraordinary growth. They are getting more business from Axis and SBI and HDFC Bank. And I think the quarterly numbers update will be very, very strong. So at 800, you have a very good risk reward of this stock being up 10%. And that could be, on the anvil of a very, very strong credit cycle. So IOC, BPCL and SBI cards are my three picks for the next week, 10 days and for the next 1 month.
All right, but Sanjeev, what's the outlook on TCS? After having put out a mixed set of numbers, the buyback news came in a little bit below what the street was penciling in. How do you expect the stock to react, and what's your opinion?
Yeah, good morning. So Avan, the street will always be disappointed. They were disappointed at 3,000, at 3,600. What do? For the fifth time, the buyback has come. Each time you sold it after the buyback and bought it back, you made 15%. In a nutshell, if you did 5 buybacks, you are almost up 120%. So stay with the bellwether. These stocks will never be available cheap. Look at the inflow of SIPs. And yes, the clouds on IT are a little bit of a skirmish. But if the yields fall further and you start to see US spending increase, then I think TCS is the most and the biggest bellwether. So I would say stay put. There are other ideas which can do well, but don't ignore a blue chip like TCS. Any weakness would be a buying opportunity.
Sanjeev, hi, morning. There's a upgrade on Zomato by one of the brokerages this morning, which believes that it could climb all the way to 160. Wanted to understand what's your take.
So Aisha, good morning. I've been inviting you to my son's restaurant and I kept saying that 25% of the margins were taken by Zomato. Now that was 50 rupees and I could see the earnings because they are making money hands over fist. No two ways. This has been one of our top holdings as a disclosure. We continue to be bullish on the fintech space. By the way, Paytm, Zomato and PB Fintech have been three of our top picks. Paytm just hit a new 52-week high. I think that stock is going to be re-rated, and so is Zomato been. So fingers crossed, these stocks may hit new highs very, very soon. That means it will cross that 140 which it hit before after the listing of the IPO. And actually, the numbers speak for themselves as you start to see profitability over a period of time.
Right. Very interesting, Sanjeev. You're sharing, your son is sharing even more higher amounts with Zomato, the charges, etc. But still, the volumes are so good that both are happy. Very good to know that. The other space which was particularly lighting up yesterday, Sanjeev, was the cement space. The smaller ones, Shree Cement, Grasim, ACC, Ambuja, your older favorite. How do you want to revisit that space? Would you be a buyer there in any of your names?
So Ajay, as a disclosure, like we said, ACC, Ambuja, Ultratech is our top pick. You can add a Dalmia Bharat because Dalmia Bharat now, even though there is a little bit of a debt overhang, but the JP acquisition makes it arguably the sixth largest player after Shree Cement. And in the sector or the region which they are, I think prices are going up across the board. So it's an indicator that capex growth, road building, all the construction activity, why is DLF and Godrej hitting new highs? In fact, the input costs materials are doing extremely well. And I would say, go with the top large cap, that is Ultratech. Ultratech can see 10,000 rupees come in this year itself.
What about your outlook on the likes of Patanjali, Sanjeev, which came out with their overall business updates? How have you read into it?
Well, Avan, I haven't had a look at that, so I'll pass that question. If you can ask any other stock, I've not had a look at Patanjali earning.
All right, fair enough. Yesterday, we did see a very impressive breakout and up move in the likes of a Grasim as well as something like Nestle from the FMCG space. Do you track these companies and what's the view?
Well, Nestle has been our star pick on the FMCG side, particularly on the back when Mr. Narayan, almost 1 year back said that they are increasing their capex by 5,000 crore. The company which invested over 15,000 crore in the last 10 years has now said that in the next 2 years they'll do 5,000 crore, which means their outlook on India is very, very bullish. And given the spate of businesses which they are in and the new launches, particularly the cereal for the newly born and so on.
Apologies for that. We'll let you go on that note. Let's take it across then to the TCS boardroom. My colleague Anisha, right there in the thick of all the action, as she will be quizzing the top brass. Over to you, Anisha.
So we have the management of TCS joining us on the show, Samir Siksaria, the Chief Financial Officer, as well as Milind Lakkad, the Chief Human Resource Officer with us. Thank you, gentlemen, for making time and speaking with ET Now. Let's start with the good news first. And the positives this time around came in from the margin front. A big beat versus expectation, 24.3 versus 23.6% expected. But it came from subcontractor costs as well as better utilization. My question to you is there more scope of improvement there? Because in our last conversations, you did indicate that they're nearing critical mass.
Okay. Good morning, Anisha. And if you look at this quarter, when we saw that the top line was sluggish, we concentrated on our cost structures, and we could deliver the 110 basis points margin improvement, as you rightly called out. That came from disciplined execution, which is mainly on account of driving better productivity, utilization, and subcontractor costs. If you look at these three levers per se, I believe there's further scope of optimization, and we collectively continue to look at these levers to drive further optimization. We also drew 35 basis points from driving efficiencies on discretionary expenses. I had mentioned these had achieved critical mass post the pandemic fall which we had, and we could reasonably optimize on those expenses as well. And that's the combination of how we have delivered it. Looking forward, with the levers available, growth when it kicks in accelerates the journey on margins.
And that's a big question. When does the growth kick in?
Yeah, we have to see. If you look at the current trends, the near-term macros are uncertain, and that's visible across the board. So what we are doing is monitoring the situation on a month-on-month basis, and currently on the month-on-month basis, trends have remained similar.
Okay, so of course no recovery that you're expecting in Q3 because I'm guessing there's a business planning which has gone into the works. So Q3 or maybe Q.
Let's see, month-on-month basis is what we are monitoring, and you would also appreciate that there's normal seasonality which kicks in Q3 and to an extent in Q4. We need to keep that in mind as well.
Okay, let's see when that growth kicks in and how much impact does seasonality have. But the other thing, Milind, has been utilization, of course, is something that you've been supporting. But if you look at the last 12 months, the cycle has very quickly moved from, the focus on, hiring to retaining and now to better utilization. How have you and the team coped up with that?
We have to adopt this to the business situation that we have been doing it. I think it is important that we are agile in this manner and adopt in a way which is basically take care of our people, our employees, and other stakeholders. And that is something which we have been doing all along, so it is not new to us.
Sure, not new, but the extent of kind of slowdown that we have seen is a bit surprising. At least in the last half a decade or 1 decade, we haven't seen that. Having said that, the headcount addition target that we had laid out at the start of the year, in terms of the fresher addition to the tune of 40,000, does that stay intact?
So, like I say, we have been campus hiring is our core part of our strategy, and we will continue to do that. We have been onboarding a large number of trainees in Q1. We have done in the similar numbers in Q2. We will continue to do it in the coming quarters. So that number, when they come in, how they come in, the total number, and all of that, we will decide as we go along.
Okay, so not clearly stating that 40,000 is intact or not. You will recalibrate the number as you go along.
I think in general that number is what we normally do. So I don't expect a significant change, but there will be a few changes based on how the project pauses which are happening as we go along, and all that stuff also is playing some impact, but not significant. Because we make a long-term investment in bringing those trainees there.
Sure, long-term investment that you are making, but since we are talking about Q3, just wanted to get a sense, Samir, is there any indication that you are getting that furloughs will be higher this time versus the traditional numbers that we have seen?
No, I think they should be on similar lines. So far, that's the indication. We don't see any different trend on that.
Okay. Yesterday in the press conference, you said something very interesting that you will take strategic calls of recalibrating margins as the tenure of the project goes. While at the portfolio level, you will try and maintain those margins. Explain to me, how does that work?
Okay. What I mentioned was that while we maintain margins at a portfolio level, at a deal level, we might take strategic calls, and we might choose to go aggressive, and or that's the strategic call I was mentioning towards. And in the project life cycle, if you look at, margins would differ, is what I had mentioned. So
last time I talked about the tug of war between you and Milind with respect to margins and freshers. This time it seems there's a tug of war between you and the sales and marketing team. Are they twisting your arm a bit in letting go of margins? Is pricing a bit of a challenge?
Well, hopefully no one's testing my mom. As I have always maintained, we collectively work as a team and take calls collectively rather than having any tug of wars across. Else I won't win against them.
Point taken. But no, what I'm trying to get at is that the competition is heating up, right? I mean, and there are large deals which are at stake right now. Does that mean that you are letting go of margins and trying to get the order wins first? Is that a bit of a recalibration or the focus area, at least in the near term?
Growth with profitability is always our mantra, and it is never that we will let go a opportunity just on the basis of margins.
Okay, so the opportunity is more important than margins, but growth goes along with profitability. Fair enough. But Milind, attrition, that was another good news this time around, a sharp reduction in attrition. Do you see further room for it improving, or do you think it will stay between the 14-15%?
I expect it to further come down to our industry benchmark levels, which we are used to.
And what are those levels, if you would remind me?
We talked about 11 to 14%. So, that has been our range, and we will come to that levels.
Okay, so going back to those attrition levels, but what about this entire coming back to office? Because I think you have recalibrated your decision there as well, calling the employees full-time to office. What went behind that thought process, and how do you plan to implement it?
Anisha, as I said before, we have hired a large number of people in the last 3 years. It is critical that this new workforce get integrated into larger TCS, and we believe the only way to make that happen is to get them to office, because it's not only about doing the job 8 hours, but it's also about being with others, learning from others. Just understanding how TCS works. In terms of not just work, but all the other things that happens in TCS, including fun. All these things are important. That's what basically eventually drives sense of belonging, and the values get instilled in our people, and that is so important. And that's what we believe that's the right thing to do. And eventually, as we'll see evolving work models, we are open to that. And we'll do the best we need to do for what is best for our employees and our customers.
Sure, best for employees and other stakeholders, but I'm not sure if you're happy with the decision. Not about coming to office, because you already were coming full time, but what happens to your margins? Because I'm guessing the cost related to employees, rent, electricity, all of that goes up. Is that going to be a big headwind, you think, or not as much?
So the primary thing is we did not give away any of our office infrastructure during the pandemic. We continued to invest on our infrastructure. And if you look at, so in its form, we don't see any impact due to a return to office on margins.
Okay, fair enough. No impact on margins, but you also had that strategy of 25, 25, 25, right? Has that been rolled back?
So like I said, right now we'll get everybody in the office. I'm not saying none of those models, any hybrid models are, it will be, not right to say that something is in or something is out. But we are open to all kinds of models based on the situation, how the situation evolves, how the entire workplace, marketplace evolves, and based on that we'll make a call. And like I said, we will make a call which is the right thing to do for our people.
Okay. The other thing I wanted to bring on board is the buyback decision, of course, right? 17,000 crore at 4150. It's a bit lower than what Street was expecting. Any reason behind that? Because I do understand it is as per your policy and within those norms, but any reason where you scaled back the overall amount?
I think overall that's a board decision in terms of the quantum and the price. If you look at it, as you rightly called out, our focus is to give substantial free cash flows back to our shareholders as our capital allocation policy, and we are sticking around to that.
But are you keeping some powder dry for some acquisitions, etc. as well? I know TCS hasn't been very aggressive when it comes to large acquisitions, but given the market position right now, there might be some consolidation opportunities coming your way. Is that something which is getting incrementally more attractive?
So capital allocations are post free cash flows. That is after all decisions on investments required, wherever it is. And if you look at it right now also, we have 60,000 crores, almost 59,000 on our balance sheet. So we have sufficient cash and a war chest available for needs that may have come.
But is that a need, or is that a strategy, acquisitions specifically?
we continuously monitor the horizon for opportunities. Our focus is that we want to do acquisitions for specific niche targeted areas and not just for adding it to the top line.
Sure, and one of those niche targeted areas that everyone is targeting of late is Gen AI, right? And everybody is talking about how it's going to impact. And the biggest question is how it will impact the tech industry back home, because one of the USPs of us is, good talent that we have at affordable, reasonable prices. Do you think generative AI is going to be a big disruption to the overall strength of the Indian IT industry in that case?
Anisha, we have seen it, so many technologies come in and gone. And we are seeing the progression. Every time a technology transition that is happening, it only adds to the jobs. That is first thing. The nature of the job changes as we go along, and that has happened over the years. This is no different. We all know that generative AI is going to be here. It's going to be transformational, and it's going to stay. All of that is what we need to do is to adopt quickly, train our people, get them to build career paths on this. And eventually they will start doing things which they have not done before, or they will start using a part of AI which they were doing it before, and somebody else, a co-pilot, is going to do that for them. But this is only going to basically add to our people's skills, and also I believe even more jobs will come as a result.
I like the terminology co-pilot and autopilot that it's coming in with. But, that entire bribery case, that was also making a lot of headlines. Could you talk to me about what clarity has emerged, and have you had to lay off some people on account of that? What is the number of people which got impacted?
So the investigation is concluded, and we have taken action on 19 people. 19.
Okay, fair enough. And before I let you go, Samir, the question that I have to ask, and I think you can pretty much anticipate this one, 26 to 28%, when are you reaching that? Okay, forget that when are you reaching, but will you end the year with 25%, and you can't use the word guiding beacon? That's disallowed. And not even aspirational. Those three words are not allowed.
Okay, then I'll say first, it's not just an aspirational target, and 26 to 28 is what we as a management team and all of us at the leadership level firmly believe that we can deliver, and that is something which we all of us are working towards.
Okay, so you didn't use the word guiding beacon, but pretty much used its definition, but at least 25% by the end of the year. Any visibility?
See, if you look at Q2, it has been credible delivery on margins. Let's hope it continues.
Okay, on that positive note, gentlemen, I'll let you go. Thank you so much for making time.
Thank you.
Thank you, Anisha.
With that, it's back to you guys.
Well, that's the top brass from TCS, but don't go anywhere. In just a few minutes from now, we'll also have K. Kritivasan, the CEO at TCS, and N. Ganpati Subramaniam, the CEO as well, chat with us in just a short while from now. But yes, looking at the takeaways from TCS management, they're saying, yes, it's a sluggish top line, but cost controls have aided margins. So look at that. And the buyback, according to them, is pretty much par for the course. But Chakri, how do you think the street is going to absorb TCS's numbers? Morning, firstly.
Yeah, good morning. I think, going into this quarter, there was an expectation that there will be a slowdown, and there is a slowdown. So I think the stock, basically, because its valuation is also kind of reflects its potential. So it does nothing much. I don't think investing in at the current levels is going to make any returns alpha in the next few months or so. So I think it's best to stay on the sidelines, and if you have, maybe trim some positions.
Chakri, you track Reliance Industries quite closely. Below 2300, did you see value in it, or even at 2350 thereabout? Do you think there's a case to get in? Because it was one of the biggest drag. It became a drag on the market overall and was just not performing for weeks now.
Oh, okay. Yes, that's right. The company basically, has the problems of the industry, and being now one of the largest companies in the space, it kind of reflects what's the industry up to. So it is telling us, the BFSI, TMT sectors and are not spending. The year-over-year numbers show that, and it's unlikely to spend in the next 6 months or so. So I think, given this, the order book is there. but it's a question of execution, and whether the execution was going to be pushed out is what is going to determine. And margin control by controlling costs is not such a great way. By having a margin improvement because of improved pricing is usually rewarded by the market.
That's correct. Are you looking at geo financials as well? Because there are two opinions out there. One is looking at building position in geo financials over a period of time. By then, a firm business plan, a much more visibility would start coming in. The others are saying that let's not waste time on that one. And we have seen promoters and management themselves buy from the open market. It appears that they want to raise stake further. So might as well position now.
Geo financials, yes, clearly it's going to be very transformative for the industry itself, for the NBFC industry. And I think, they will have a huge net interest margin advantage as they scale up. This is the right time as in the beginning of, as they embark on their journey, and as India gets into the festive season, and there is a eventual pickup in consumer spending. All these three, and they have an established brand name, which is a very big factor. All these factors is going to help, and they have the capital base. So now they have made plans in terms of raising capital and also using their leverage. I think all these things are going to work in Geo Financial's favor.
Chakri, morning. What's the outlook when it comes to the OMCs, in particular something like a BPCL? Just today, there's a fresh brokerage note from Citi saying that the Q2 earnings performance will cement a very healthy interim dividend. And you've also got concerns with fuel price cuts, which will now ease the dates for the elections. What's your view?
OMCs have traditionally been a value play and will continue to be a value play. And the closer that we get to elections, I think it's best to remain on the sidelines, because if there's going to be some kind of a impact on their ability to make price changes, that kind of shows up on the margins. And so I think, these are companies which are at the current levels are best left on the sidelines.
Fair enough. What's your outlook then when it comes to the entire steel space? The fact that over the past few months, we've seen a pretty decent performance for a lot of these companies. Do you remain guarded on the space, or believe that there is more upside potential in the likes of SAIL, JSW Steel, JSPL, Tata Steel?
The valuations are, pretty much in their favor. But what is not in their favor is the demand outlook. China is soft. US is still trying to figure itself out. Europe is clearly heading towards a recession. Against this backdrop, clearly demand becomes the casualty. And these are cyclical companies. And so with this uncertainty, and US has not reached a peak of interest rates, so which is going to impact, the capex decisions made by any cyclical, by steel companies. And therefore, while valuations are clearly in their favor, I would still remain on the sidelines as it relates to the metal sector.
Okay, I have with me the management of TCS, the CEO N. Krithivasan, as well as CEO NGS joining us on the show. Good morning, guys. Thank you so much for making time.
Thank you. Good morning.
Okay, I wanted to begin by asking you, Krithi, yesterday you went at great lengths to try and explain to us why the disconnect is there between revenue booking as well as, deal signings. But just help us understand, is the disconnect happening on account of some deals which are coming to completion, or there's also pause or delay in the rest of the deals which are ongoing as well?
Everything, right? Like what happens usually, like we have some large programs. And if some of those transformative programs come to an end, then it has to be, that revenue has to be replaced with something else. And there are also customers looking at what is the return on investment they are getting on the current ongoing projects. Do they have to reprioritize them? Do they have to optimize them? So some of those decisions are taken. And sometimes some projects get paused as well, if they don't see a ROI. Now, at what pace we are able to replenish this loss in revenue? If we are normally in a good quarter, we will be actually adding more at the top. So what goes out of the bottom is less, and you are able to show a good growth. But when customers are looking at cost optimization very strongly, we get into a situation where they pause more projects or more projects are not replenished. For instance, in last quarter, we had a major project in Europe coming to an end. Okay. And it's very difficult to replace that kind of revenue to a large project. So such situations result in your degrowth as you see here. Now, I'm sorry, flat growth as you see here.
Okay, fair enough. But is that likely to continue for the next couple of quarters as well? Because you would have that plan in place in terms of how deals are coming to an end or seeing a bit of a pause?
We know what normal projects are coming to an end. We also know what is the new revenue we are adding. But what we will not know is how customers reprioritize other ongoing projects based on, see, the return on investment is based on their perception also. What are their benchmarks on continuing the project? That view we will not have. So, and that view also keeps evolving based on their outlook on how the economy is going to turn out to be. So, it's difficult to predict. Like, we definitely know the ongoing projects which is coming to an end. We know the new projects, but there are quite a few unknowns as well.
Quite a few unknowns, and I think that's the reason NGS said that they're looking at only 15-day at a time. I don't know how do you plan a business with just 15-day visibility, but at least there would be some internal estimates, right? When do you see the recovery? Is it going to be the second half or let's say Q4 this year or only in FY25?
We call it agility, right? So, if you have to do it, we all used to do a quarterly and annual plans, etc., etc. But, we do have an annual plan, but then the parameters that we need to juggle are so much. Then one has to be frugal, one has to be agile in the current circumstances. Coming back to your question on, whether it'll happen, how H2 will be looking like, and are we seeing a Q3 to be better? It's seasonally a weak quarter. As he explained, I think, we have some visibility into what we will do. But there are uncertainties in terms of how customers will reprioritize some of this. This quarter is also a year-ending quarter for many of our customers. So they will also try to shore up whatever they have to in their P&L, in their books. So I think Q3 is a number of working days is less. So we'll have to take all this into account while calibrating what we will do in Q3. And to that extent, I think, it doesn't look like, Q3 will be a very strong Q3, right? Unlikely. But we'll wait and see on how Q4 turns out.
Okay, but at least are you seeing that the furloughs or seasonality is going to be much worse this year versus the historic averages, or it's going to be in line?
I think it's going to be in line. We don't have any interactions with customers to the contrary.
Okay, and just a last word, when you said the recovery will probably start in Q4 or it will be FY25 only?
Very difficult to say, as I said, but first is that we are now looking at Q3 and then see how we'll perform in Q3. How do we continue to be efficient? How do we continue to execute well? If we have enough people and enough bench, can we execute some of those projects ahead of time? These are all the thoughts that goes in our mind, right? To ensure that we have a decent Q3 and then worry about Q4, right?
The amount of parameters you have to juggle with, I wouldn't want to be in your shoes. It's very difficult to manage all of that. But Kriti, one thing which has been holding out is the UK business, right? A good growth of almost 11% year-on-year basis. What is supporting the strength there? And secondly, when you look at it in comparison to North America, which is pretty much flat for you on a year-on-year basis, and it's a very large market for you, what's happening there?
See, in UK, our participation in major programs has been very, very high. And we are the number one IT player, at least in the kind of work we do, for quite some time. And so it gives us enough opportunity to participate in every large deal. So compared to the size of the market, the kind of projects we win there are very big and quite, I shouldn't say disproportionate, but very high. And and also the behavior of the customers or the perception, like few quarters ago we explained, maybe it's possible in UK, they have factored in a weakness in economy, and so their perception on what projects should continue, what should not continue is also quite different. And the third aspect is some of the very strong deal wins we had in the past in UK. All these things put together or ensuring that we are able to add more in UK and continue to get the revenue. US, you all know, like there are a lot of uncertainties, multiple factors at play. So, which for us also a large market. Banking, there is a certain amount of while the banks are doing good for the current, but there is an uncertainty on future. Retail is weak. Some of the sectors within retail, some the essentials and all, which used to be strong, they are showing weakness. So manufacturing is doing good globally for us. So US is we will probably need to take maybe some more time for it to come back to strength.
Okay, so a few more quarters before US...
I don't know, a few more quarters, I said some more time.
Some more time before US comes back to that strength, and for now BFSI and retail is a bit weak, manufacturing is doing well. But NGS, in terms of the deal wins, that has been very robust this time around as well, $11.2 billion. But the question is, what about the pipeline? Does it still remain as strong as it was earlier, the funnel for the fresh deal wins?
Absolutely. I think we see a strong pipeline, a lot of qualified pipelines consisting of deals of all shapes and sizes. Almost all of those opportunities now come with digital and cloud technologies, and we launched the AI.cloud offering, taking a cue from all the opportunities that we see. How do we bring cloud, data, deep learning, machine learning, those kind of technologies, including some parts of generative AI into the whole thing. So I think pipeline looks very strong.
Okay, so pipeline looks very strong, but this is a question I was asking Samir as well. Is there a tug of war with the sales and marketing team to let go of the pricing and margins a bit to get more aggressive in the bidding? Is that the case?
No, like we take a very strategic call on it. It's not a tug of war between sales and marketing and delivery teams. Like we take a strategic call. We decide what is the value of the deal to us in the long term. Okay, and if we find the value of the deal in long term, and I mean value of the deal, not only from that deal, by doing that program, what else we can do, we look at everything and take a call. In TCS, rarely you would find teams fighting on these things.
It was on a very lighter note, but nonetheless, what I want to understand is pricing getting more competitive? Because a lot of global players are fighting for all of these large vendor consolidation deals. At least that's what we hear. Your take?
Pricing will always be competitive, but if you look at our last quarter realization, we have been able to hold on to our overall realization and pricing. So at the company level, we don't see a pressure on that.
Okay, no pressure. But, just coming back to that deal, when you said there is various nature of deals which are there in the pipeline, but in between we have seen that there were smaller deals which were getting a lot more converted versus large deals. Has that turned now? Is it a lot more larger deals and vendor consolidation, cost optimization deals which are coming in versus the smaller deals which have been put on the back burner?
I think so. I see that happening. There are a stream of small immediate term deals which are related to, let's say, proving a technology, or how do I adapt the architecture that I have into bringing in generative AI. Those kind of smaller deals do happen. But given the cost pressures that our customers have, the focus on prioritizing, cost and optimization is there. So that results in a good number of outsourcing opportunities, vendor consolidation opportunities, in which we are participating. The long-term deals that we have been working on, which typically, that the horizon is about 12 to 18 months to shape. So whatever we have been shaping, I think they're all maturing. I've not seen, barring a very few instances, but majority of the long-term deals or large deals that we have been working on, I think they seem to be intact. They continue to engage with us, and fact is that we have concluded 2 mega deals in this quarter.
Talking about one of those mega deals, BSNL one, what's the timeline of the execution of that? Because I understand you're looking at completing it within 12 to 18 months as well. But what about the margins? Is it a project which is coming in at a bit of a lower margin as compared to your other averages?
So it's, I would say so. Say so. But then it's much more strategic. This is a completely indigenously developed technology. Rolling out a modern 4G, 5G network, which is software driven, and the radios are software driven, and looking at the intelligence on the edge, and see how do we roll out a network which is self-healing, self-optimizing, and bringing a lot more cognitive things into it. So it's a very, very strategic deal in that sense. We don't get this scale in anywhere else in the world. 100,000 plus towers, pan-India, across different terrains, different weather conditions. How do you calibrate these radios? What kind of algorithms that you will have to build so that the capacity, the experience and the coverage that you want to give it in the network is really superb. So it's both intellectually challenging, at the same time, executing under some trying circumstances is the kick. And certainly it will open up a lot more opportunities across the world.
Sure, a lot more opportunities, but have you started the execution now itself, or it will start from Q3, Q4?
No, yes. We have already started it. We have started to roll out the sites in about 2 circles in North Zone as we speak.
Okay. He was talking about generative AI and how that's, of course, coming up in a lot of conversations. But are clients investing big time into it, or do you think that it's still very experimental in nature and they're just looking at maybe doing some, pilot projects for now?
See, our customers are thinking about it a lot. Okay, and they have started investing, and many of them are also trying to experiment with large language models, like what does it mean to them. Some of them are creating sandboxes where they can test out some POCs or use cases. So, but it's like adoption of any technology. Yearly it starts slow, but it will pick up momentum as customers gain confidence and on the value that it can bring to them on the long term. But it will definitely pick up momentum and pace as we go along.
Okay, so likely to pick up momentum, but wanted to get a sense from you as well as far as the internal restructuring that took place just in the quarter gone by. Have you started seeing fruits of it already? What was the rationale behind it, and is there any such more restructuring in the pipeline that you're thinking about?
See, the rationale I think we did explain internally also. See, we wanted to bring the whole power of TCS to each and every one of our customers, and that could be done like if you are able to keep all the customers that belong to the same industry in single group. That's where, and the customers also felt that they were getting the full power of TCS by that, and our associates are also they're trying to, the sense of belonging was I belong to retail or I belong to banking, that we felt that comes more naturally. So the immediate results definitely are there to see. We find a lot of positive comments from our customers as well as from associates that they're more happy with this setup because it appears more natural to them. And any other future restructuring, like we keep looking at what is good for us, right? I was telling yesterday also, organizations keep evolving, right? And we continue to tweak the structure as what we think is required. And now we are more agile, like from a previous structure to this structure, we are able to transition in less than a quarter. So it gives us more confidence that if we have to tweak, we will be able to tweak.
Okay, able to tweak and be agile, but are you looking at $9 to $10 billion as the quarterly run rate for deal wins going forward? I know we throw this question at you every time, but what's the answer this time?
No, I think we are happy that we have clocked 10 billion plus in 3 successive quarters, and the more we do, better it is for us. So internally, we always keep pushing the bar, but externally, I don't think that there is any need for me to commit, saying that we'll be in this range or that range. But we are happy that, look, the pipeline that we have, we should be able to do well on the order front.
Okay, but you talked about yesterday how 70% of your productivity got free on account of the generative AI that you are using. I want to know, what are you using and how are you able to free up so much time?
No,
Give us some tips.
It's about trying out a new technology. When somebody says that the new technology has come, you try it out first so that you understand the art of possible. So I've done some of this. For example, a lot of my interactions over email. Majority of the emails, I find that, look, it is able to mimic my language. It's able to mimic and then put everything in the draft folder so I can review and then I can quickly click on it. That's one example. And then the meeting scheduling is pretty much, done, and I just have to say, yes, I accept this meeting, then it goes off. So many such examples are there. And internally, if I want to draft a mail communication, generically, I use it to it comes up with a draft which is better than what I normally do. So it's so as individuals, I think we all love it, this technology, but how will it pan out for enterprise level is something that we are calibrating, and our customers are calibrating. The challenge is for us to make sure that it is responsible and it is behaving the right way and keeping the customer's interests and individuals' interests always ahead of its own intellect, right?
Smart use of that. But since it's also the time of World Cup, let me throw in a cricket analogy. The pitch is uneven. We're seeing a lot of Yorkers coming your way. You'll be able to hit it out of the park in FY25?
A helicopter shot is in the making.
Okay, on that note, I'll let you go, gentlemen. Thank you so much for making time.
Thank you so much. Appreciate your time.
Appreciate this. Thank you.
Well, a helicopter shot is in the making despite the uneven pitch. That's what the top management of TCS has to say. But is the street convinced? Well, there's a complete dichotomy right now. If you look at the performance, quarterly performance on earnings side, commentary, or even stock performance between large cap and mid cap IT companies. Chakri, you must be listening to the commentary coming from TCS. But if I were to take your attention to the mid cap IT universe, KPIT is at a 52-week high, and Emphasis, Coforge, Birlasoft, this universe is having a party of their own. No very apparent slowdown as well in their business momentum, and the stocks are doing very well as well. Would you hunt for opportunity here in this universe, the mid to smaller cap IT names?
All the names that you've mentioned have benefited from the fact that their core competency has actually has not seen much of a demand slowdown. And when you look at the large companies like a TCS, Infosys, the mega large players, they are impacted by what's happening with the industry. So if there is a US slowdown, Europe slowdown, etc., they are impacted by that, and less so for the mid-cap companies. So against that backdrop, now these companies, Emphasis, have all done well. Now, would you incrementally invest in them? The answer is not really, because the valuations pretty much reflect. This as an area, will it continue to generate faster order flow versus the large cap? The answer is yes. So if you, the answer is the mid caps have run up, so therefore I wouldn't really invest, and the large caps, I think there's still time.
I guess. Okay, Chakri, in the cement space, as monsoon is just now coming to an end across the country, and this time, despite a monsoon, cement names were pretty active. There's anticipation that there would be a countrywide surge in capex, driven, of course, by the government, state governments as well as the central government. Which of the names you find extremely compelling right now on risk reward from the cement universe?
Yeah, in terms of a capex surge and infra push surge, yes, I think clearly that is one is expected, and two, it's happening. If you look at road building, I think 1 lakh crores over the next 6 months. Road building has actually slowed down, so an incremental demand from them for the cement industry will also clearly show up in the numbers. I think it's, if you look at some of the north-based players, not the companies focused on the northern markets, they've managed to push through some pricing which the southern players have not. So against this context, but volumes are good, 14, 15 plus. Pricing is not great, but costs have come down. So against this background, Dalmia Bharat, JK Cement look good. I think UltraTech, being across the country, will face some kind of a pressure as far as in terms of not able to push through prices across the country. Only in certain pockets it can push through. So it's Dalmia Bharat and JK Cement.
Okay, there you have it, sharing with us your top mid-cap recommendations from the cement basket. But it's 9 a.m. Let's find out what exactly the pre-open rates are indicating, 9:05 actually. And for now, that it's up about 22 odd points, 19,800 being maintained. And for the Sensex, we're up in the green too. What about the mid-cap recommendations then? What is it that our chartists are picking out? Kunal, what's looking good today?
So I'll go with the buy on Zomato. That's a stock which I highlighted in a few days back at 102.3 levels. Now the stock has climbed back towards 109 odd mark yesterday. So it looks attractive, and expecting this momentum to continue to at least 120 mark for the stock price. That's a buy. Stop loss for this trade 103.
Okay, Zomato and Naresh, you picked out a lot of mid caps earlier this morning. So add to that list. What's looking good?
So another small cap, that's a buy on JK Paper. The whole sector has gone through a good enough consolidation, the largest player being JK Paper. The stock is at the same price where it was almost a year and a half back. In the short term, it was getting, after making a move from 300, 310 towards 410, a new range was made between 380 to 410. Yesterday, it came very close to 410. Large volumes, expecting this to break out and go into a new 52-week high. A stop loss at 385, target price of 450.
Right. Okay, let's tell you what else is happening outside the world of markets. And as the war between Israel and Hamas now enters the sixth day, the Israeli Defense Forces have stepped up attack in and around the Gaza Strip. The new round of escalation has so far claimed over 3,000 lives. Israel also has announced the formation of an emergency unity government and a war cabinet too. And as India has begun evacuating citizens from war-torn Israel, the government has launched Operation Ajay to repatriate Indians by special flights today onwards. In fact, the embassy has emailed the first batch of registered Indian citizens in Israel. And 4 people have lost their lives while several others were injured after 21 coaches of the Northeast Express train derailed in Bihar's Buxar last night. In fact, the derailment occurred as at least 2 coaches toppled and 4 jumped off the tracks. The rescue operation has now concluded and efforts to restore the rail service are underway.
Meantime, ISRO will be executing the first of its series of test flights ahead of the Gaganyaan mission on the 21st of October. The test flight will be launched from the Satish Dhawan Space Center, and this involves launching the module into outer space, bringing it back to Earth and recovering it after a touchdown in the Bay of Bengal. And to the world of sport, India continues their winning streak in the World Cup. The captain Rohit Sharma broke a 40-year-old record. He scored the fastest century in any World Cup, leading the team to an 8-wicket victory against Afghanistan. India will now be playing against Pakistan on Saturday.
Chakri, yesterday you must have observed the action in